Hi, Phil again. So, in these short videos, which there might be very few of, we are talking about common tax questions, and that's me getting emails, 'cause I'm a real lawyer. We're talking about common tax questions that you and I get or got all the time as tax practitioners, and usually tax practitioners that work with, I think the way I summarized it in the last video was really good, professionals. And these are usually doctors, lawyers, executives, so people making 1, 2, 3, 4, 500 grand a year, and usually will have saved up 1, 2, 3, 4, $5 million a year for retirement. Common tax questions that arise that I can answer in a short video, somewhat simply, in a non-organized way, but you're not paying me $360 an hour for that, so it's free. Question is it more advantageous, pursuant to our tax system, to pay yourself dividends instead of a salary? You get that all the time, right? So people will ask that when they have a company. Usually people will have a company when frankly they should not, right? They'll just start a company when they start making some money because they think there's a tax saving from that. Usually the answer is no. Usually if you go to a legit lawyer who does not have time to take on the majority of cases that come their way, they will not advise you to do that, because usually even if there's a tax saving, it will be significantly outweighed by the actual cost of administrating your company year after year. Usually if they are, again, an actual lawyer that's done a lot of tax investigations like I have for clients, they will tell you that you're very likely, if you have a company, even if it's worth it financially, if the benefit's not significant, you're really likely to do something wrong that will constitute a risk that will just not make it worth it. So for example, you will not charge the expenses to the correct credit card. You will not pay the expenses out of the right bank account. And then I'll tell you, make yourself an invoice, knowing full well that you will not do that until someone asks for it 2 years later and you've forgotten about it. All of that can be a ticking time bomb. It works until it works, and then when the government comes looking, you're screwed, and I have to fix it. So lots of risk, and one thing that you could see even worse than that is not have a bank account and then meddle your funds between your company and yourself. And then if you get sued, right, the counterparty will say the company didn't exist at all because it didn't have a bank account. That's even worse. So all that is a risk that usually doesn't make it worth it for you to have a company. Again, you see I'm very digressive starting off. So short answer, right? Generally, you shouldn't have a company because it's not worth it. Nonetheless, most people will come in and have a company because they heard somewhere that you pay less tax if you have the company, which is kind of true, but really probably not in your situation. So if you're making, for example, $200,000 a year, and that's or less, and that's money that you plan to spend, there's no actual benefit to having a company. So the short answer is there's a benefit to having a company because the corporate tax rate is lower on money that you would not spend. So if you're making 150 or 200 grand a year, if you make that as a company, well, then you want to spend that money anyway. So you're paying yourself. Well, it doesn't make a difference. Why is that? It's a big concept here, is what we call integration in the tax system. And integration means that you pay your taxes anyway. So if you are an individual and you make $200,000 a year, you will pay an amount of tax percentage-wise that goes up to about 50%. As I said in a previous video, it's just about 50 in Ontario, about 53.31 if my memory is good in Quebec, lower in other provinces. You'll pay that, again, other video as well, right? Doctors, usually doctors, will say, I pay 50% of my income in taxes. You do not, because we have marginal tax rates. So on the first 15 grand, it's free. Then the tax rate goes up progressively through brackets, right? Which we won't get into because it's not the topic of this video, but it's only on the $150,000 and more or so that you pay the big rate. So you pay the taxes, whatever it is, right? It's going to be 35, 40, something like that if you make 200 grand. That's the money that the government has decided it is entitled to get. Integration says, if you split it into two operations, namely, the company makes money, pays tax, less than 50%. Then, eventually, when the money gets out of the company, someone pays tax again. Integration says, the sum will be the same because otherwise it's not fair. So you do pay a lower rate, but then when the money leaves the company, usually it's what we call dividends, the additional tax that gets paid makes it such that the total is the same. So on the $150,000 and more, you will still pay 50% or so in taxes. That means that if you will spend the money anyway, there's no benefit to having a company because the company makes money, makes 200 grand, right? Now you pay a lower rate, could be, 20 or something. But then you've got to get the money out of the company because you want to spend it. Oh, well, the total, again, is the same. There's no benefit. Your friend told you there is not, right? That's why you should have called a lawyer before. So no benefit. And on top of that, now you're stuck with a company, which again creates lots of costs and all the risks that I mentioned that I would strongly advise against. It's when you do not spend the money that it starts being a benefit. And the benefit is not that you pay less tax, cause integration. You pay some tax when the company makes the money. When you get that money out, could be not now, because we said you don't have to spend it. Could be 20 years from now. Well, 20 years from now, you will still pay a rate that makes the total 50. So the benefit is not that you pay less tax. The benefit is what we call a tax deferral. That is, you pay taxes later. That's the benefit. It's not less tax. It's same tax, but not now. That's a benefit essentially because you make money in the meantime with the money. That's the benefit of a deferral. So the government would have taken 50% of your money. Now it only takes 20. Well, now you've got, say it's $1 million, just making things up, right? Now you've got 800 grand to invest instead of 500. And over time, that 300 grand will make you a lot of money. So, and at the end of the day, whatever money you've made, you will pay a total of 50% on. But you'll have a lot more of it, okay? You don't have to understand this, probably won't the first time around, but the point is important, right? You'll have more money essentially because you got the government's money in the meantime, and you got to invest that, make money off it. So whatever you will pay that 50% on later on, you wouldn't have otherwise, because the government would have taken the money. So you wouldn't have that 300 grand to play with and make tons of money with. That's the benefit. So short answer, it is never more advantageous to pay yourself as dividends than it is to pay yourself a salary, period. It does not matter how much money you make. if you have a company, if you're incorporating yourself as a professional, right? And I'm oversimplifying things, right? It's 90% of the time, it's a Canadian controlled private corporation, as we call them, simplifying things. They got to be simple, right? It is not better to pay yourself dividends. The total is the same. If you're going to pay yourself 200 grand a year to spend it, whether you call that a dividend or you call that a salary, you will pay the same in taxes. On top of that, there are lots of reasons why it's better to pay yourself a salary. The downside is you pay essentially what we call payroll taxes on that. So you pay taxes that you don't pay on dividends that are only applicable to a salary, namely taxes that fund things like unemployment insurance, certain maternity or parental leave programs in some provinces, etc. But you also get benefits with a salary that you otherwise would not. You get to contribute to your RRSP, right? The limit for which is 18% of your income up to a certain limit, which is about $160,000. That must be over that this year because of inflation. That's a benefit because you get to put some of your money tax-free somewhere. And there's other benefits like retirement plans that you get in some provinces. So generally, it's actually better to pay yourself a salary. The total tax is the same, but there are benefits with a salary that make it better. So the short answer is, again, no, it's not more advantageous to pay yourself as dividends because integration. Second, to oversimplify things, right? If you want more specific advice, you'll have to hire a lawyer, but it is usually better to pay yourself as a salary than as dividends up to what you spend, including an 18% that you put in your RRSP up to the maximum. So pay yourself what you'll spend plus the 18% you want to put away in your RRSP up to the limit. So knowing that there's a limit. So if it's above 150, it caps at 150. So that's just in the math portion of it, right? So you won't do 18%, you'll do the maximum then if you're making more than 150 in adding up these two factors. That's a simple answer. It's better to pay yourself a salary for what you spend plus maxing out your RRSP for the year. So the benefit is when you make more than that, and that, so we're talking about, right, generally, unless you really don't spend any money, you're talking about making over $165,000 a year, of which you spend, quick math, 130 or so. So, right, pretty high. And then there's got to be a good enough delta, a good enough difference there for it to be worth all the headaches I talked about, right? The compliance stuff, right? The not messing up your invoices and your bank account stuff, and the actual cost of having all this beautiful stuff, right? Like the company's got to have corporate records, it's got to have corporate filings, someone's got to write that someone's charging an hourly rate, right? They won't go out of their way to tell you that there's an annual cost of that you have to take into account. Then it becomes worth it, because on that additional income, you only pay, when you make the income, the corporate rate, which is far less than 50%. And then the benefit you get, again, is not less tax. It is a tax deferral. It's that you pay the tax later and make money in the meantime. We'll try to make other videos on all the exceptions to that, because as I said in my other video, the government's already thought about most of the stuff you thought about. It's already thought that doctors will start companies precisely for that reason. We'll start companies when, really, doctors are great, right? I work with tons of doctors. I tend to have, all my previous relationships for some reason with doctors. So I love doctors, right? But the government thought that the doctors will try to start a company for that purpose. And the government's also thought that, right, you're not really, as a doctor, respectfully meeting the general benefit that's thought to accrue from a company. You're not really taking risk, right? You don't have clients. You've got one payer, that's the government. So you're not taking risk in starting a company, and the government doesn't think you should get a tax benefit, basically, right? Tax benefit, it comes with that risk. So there are lots of exceptions. The main one being what the government calls and I've got the name in French in my head, so I will not give you the exact phrase, but basically a business that provides personal services. So if you start a business with that scheme I've just described, where you have a single client and you're basically trying to defer taxes on basically the money you wouldn't spend and therefore save for retirement, the government's thought of that. And well, I mean, Trudeau thought of that. It's relatively new, and the conservatives don't want to strip these rules. But Trudeau thought of that around 2015, and has rules for that prevent it. So the government will say, well, if it's that kind of business that's got a single client, right, where basically it's right, Phil the lawyer suddenly becomes, or Phil it's a bad example, because I do have more clients as a lawyer, but Phil the law firm partner. So law firm has lots of clients, but Phil the law firm partner, right, physical person, makes, I don't know, 500, 600, 700 grand. Then Phil Inc., the law firm partner now, has got one client, that's the law firm. Same thing as the doctor, right? Doctor's got one client, it's the government. That, when you turn yourself into Phil Inc. or Dr. Inc., that's basically prohibited. So the government won't prevent you from starting a company, right? What it will do is say that's a special type of business that does not benefit from the tax deferral. So basically the government will say, as the business, you get taxed like an individual. So you'll pay the 50% at the company level. Basically, it strips away the benefit of having the company. It's as though you paid yourself. And of course, as you have learned today, when you get the money out of the company, you won't pay any tax because you've already paid the 50%, because integration. So the government will say the company pays the 50. Well, again, integration says total is 50. So getting the money out, of course, you won't pay another 30 that you otherwise would pay because integration. But basically, the government has rules to limit the tax benefit. And these would be, in more detail, at least, the subject of some other video.